PN Vasudevan, Managing Director and CEO of Equitas Small Finance Bank, joins us. Now, Mr. Vasudevan, good morning. Thank you for joining us. Now, NIMs for the quarter, or NIMs rose for the quarter gone by, but the street is worried that NIMs have actually peaked. Where should we see them in FY24, and at what level do you think they will normalize?
Yeah, see, our normal NIMs are generally in the range of about 9%. It's been there for quite a few quarters now. We do have a rising interest rate scenario. Our cost of funds has gone up to 6.6% in the fourth quarter from 6.4% in the third quarter. So definitely cost of funds is rising, and I think the cost of funds is set to rise further over the next 2 quarters as some of the old deposits at lower rates will get replaced by new deposits at higher rates. So there's bound to be a further increase over the next 2 quarters in terms of our cost of funds. Part of that cost of funds increase we have passed on to the borrowers by way of raising our interest rates also. And part of that cost of funds increase we are able to absorb by internal efficiency improvements in the system. So on a combination basis, we do expect that the current level of NIM should sustain in the short term. In the medium to long term, the NIMs might come down as we introduce new products which will have different type of operating cost metrics. So as that happens, the NIMs might come down, but proportionately we expect the cost of operations to also come down so that the net spreads may still be protected.
You guided for a loan growth of 25%, but you have also grown at 35% in FY23. Given the tailwind for microfinance and small business loans, do you believe that you can sustain this kind of fund growth on a higher base?
So, see, we do operate in segments like, the small business loan, the used commercial vehicles, the microfinance, and affordable housing finance. All of them have a very high level of unmet demand in the market. So, generally speaking, demand is not really a constraint as far as Equitas Bank is concerned. So it's all about our internal capability to manage the risk arising out of growth. That's a more important aspect as far as we are concerned. And last year as we guided for a 25% growth, but ended up with around a 35% growth, largely because the collections were extremely robust in the second half of the last year, and that kind of propelled the disbursements also to record levels. However, for FY24 and going forward from there on, we still guide for a growth of anywhere in the range of 25 to 30%. So that's our sweet spot. I think between 25 and 30 is where we generally should be, looking for growing up the advances.
Right. You're also guided for a 1.5% credit cost in FY23, and microfinance and small business is fragmented, but it can be tricky. So, what is your own sense on credit cost guidance, not just for FY24, but for the medium term as well?
Yeah, so gross advances increased by 12% plus in this financial year. The guidance we are giving again at around 11 to 12% for March 24, for the reason being that the base is now high and
Right. You also focused on deposit growth, which is a strong one in a tough environment. How sustainable is the 30% deposit growth number? And also, you're looking to work on your current account growth, which has been a bit of a challenge. How's that journey coming along for you?
Yeah, so our deposit growth was quite robust last year at about 34%. And this year we continue to expect deposit to strongly grow. Because we need around 25-30% growth in deposits to support an equivalent level of growth in assets. And so we are geared for that. And we have a sufficiently large number of branch network to enable us to mobilize the deposit required for business. In terms of the retail deposits, retail term deposit (RTD), we have done fairly well last year. It grew by about 25%, but this year we expect that to maybe even inch up a little bit more than 25%. In terms of the CASA, our CASA ratio is around 42% as of March 23, and it's going to be a struggle to help retain that through the current financial year. because you know that the interest rates on deposits have become very attractive. 1 year deposit attracts a rate of around 8%. So customers who have some amount of cash in savings and who are willing to keep it away for about a year or more would prefer to move it to a term deposit rather than keep it in savings. So the holding that 42% is going to be a challenge, and that's something that we are really seriously working on multiple areas and fronts to try and retain it at 42% through the current financial year. And in terms of current account that you mentioned, we have been putting a lot of efforts in the past, and some of that has borne fruit last year. If you see our current account balance has actually grown last year from around 600 odd crores to 950 odd crores by end of the year. So it's a pretty decent growth that we saw last year on current account. And again, it's going to be a challenge to retain and grow that further, but both on CA and on CASA, a lot of effort from our side to ensure that we retain a pretty healthy ratio of overall deposits.
So Vasudevan, morning. Now, given that you have said that margins will sustain and your cost to income as well will remain stable, what is the outlook on ROAs?
So we have been always mentioning that as a business model, we want to generate an ROA in the range of 2% plus. That's what we have been always mentioning for quite some time now. And so ROA of anywhere around 2.25 to 2.3 is something that is the basic level of ROA that as a bank we would like to always commit to and try and deliver. So 2.25 to 2.3 is something that we should expect to see going forward. Subject to no other black swan kind of an event coming up. Otherwise, this should be our steady state ROA going forward.
And before we let you go, given that the markets clearly appreciate a stable leadership when it comes to banks and, of course, companies across the board, I'm sure the street is curious to know that we can safely assume that there's no question of you leaving your position. Where is the bank when it comes to your extension? Have there been any talks?
So my current tenure ends on 23rd of July this year. So we have applied to RBI. The board had approved a 3-year extension 3-4 months back, and post that we have applied to RBI for an extension of 3 years. So we are awaiting the approval and feedback from RBI on that particular account. In terms of on an ongoing basis, yes, there was this issue that I did want to leave, but then I reversed, and now we declared that I'm not leaving and I'll be staying back. Now there is no question of going back on that commitment any further now. As per RBI guidelines, I am allowed to continue as MD CEO of the bank for a total of 15 years, and I have completed so far around 6.5 years. That really leaves me with another 8.5 years of tenure left, subject, of course, to RBI approval and shareholder and board approval, and of course, God's grace. So, subject to God's grace and subject to approval from RBI and others, I should be here for the next 8 years.
Mr. Vasudevan, great to have you on the show today. Thank you so much for highlighting all about your earnings and the future visibility. Let's just take a quick talk of where the market has settled in at. Not